Nike is down 12% after reporting its earnings, and in today's episode we want to find out whether or not this company is undervalued, why it has dropped by so much. We're going to run it through our valuation model as always, based on the updated numbers, get to our intrinsic value and our acceptable buy price given our investor margin of safety. We're also going to take a look whether the institutions are still buying this company, whether or not they're selling. We're going to do a brief discussion on their market share, whether or not this is increasing or in fact the opposite in contracting. And we will find out their dividend safety score alongside some very important financial metrics for this company. We'll touch upon how they do compare year to date and for the last 5 years versus some well-known competitors. And we'll touch upon the health of the company, their balance sheet, total cash, total debt, and understand their top line revenue as well as their bottom line net income, how it is progressing. As always, if you're enjoying the content, don't forget to hit that like button and subscribe and hit the bell button so you do have these videos delivered as soon as they drop. So let's jump in, and firstly let's start off with the earnings. Now, we can see it was down 12%, although it has recovered by a few percentage points. And the top headlines state that they plan to cut $2 billion in costs over the next 3 years, and they've also cut their revenue outlook for the financial year, so that'll be important. We can touch upon that, and we can see they did fall short of Wall Street's estimates. So let's get into the article, try and understand what exactly is going on. So we can see Thursday they unveiled plans to cut costs by around $2 billion over the next 3 years, and they've also lowered their sales outlook. Now, some of this cost cutting will be due to restructuring and a lot of people losing their jobs, and we can take a look at that further on. Now, why exactly is this happening? Well, they expect essentially their full year reported revenue to grow by only 1%. Now, for those that watch this channel regularly, you know we look as a minimum for 4 to 7%. If they're not getting at least a minimum of 4%, well, what that means is they're not even keeping up in line with inflation. Now, the prior outlook that they did have was mid-single digit increases, so this has dropped quite substantially, in my opinion, to 1%, especially when you do consider the holiday season, and they expect their revenue in comparison to prior years to be slightly negative. So, a lot to be wary of for Nike investors as well as those who are looking to essentially move into this company and put their hard-earned money here. But what we do see is they do still expect their gross margins to expand by around 1.4 to 1.6 percentage points. And one thing that we do need to understand when looking forward is they expect a softer second half revenue outlook. Now, a few things just to bear in mind here. They are expecting this to in effect be negative in comparison to the prior year, but they are only expecting this to be essentially a 1% increase year on year, and you know how I feel about that if you have been watching these videos regularly. And they do plan to effectively do a lot of restructuring charges, and as we can see, the most related of these are the company our employee severance costs. So a lot just to bear in mind there, not only for investors but for those that are considering to buy. Now for the numbers, earnings per share, well, they did beat on the EPS quite significantly, in fact 103 versus 85 expected. Revenue though, this is where they did miss by quite a very amount. So we can see 13.39 billion versus 13.43. Now, let's take a very quick look. Now, it has recovered slightly, down only 8% as opposed to the 12% we initially saw. It is still in the midpoint of the 52-week range with a yield of around 1.21%. Now, if this is a long-term holding of yours, over the last 10 years, it is up around 179% without those dividends included. But we can see it did peak at around $177 at the end of 2021. So it is still quite some way off their all-time high. Now, what does their top line look like? Well, 39 billion in 2019. As we said, we look for around 3 to 7% growth year on year. May 23, 51.2 billion. So it is positive to see that it has grown over the last 5 years. We can see some inconsistencies. It did drop during that COVID year, which to be honest is quite understandable with lockdown, people not being able to go out and buy their products. Although it did rebound nicely all the way to 2023. But as we heard, 2024, they are expecting their results not to be that great in terms of revenue growth. So do consider that. On the bottom line, what is the story there? Well, 4 billion reported in 2019, 5 billion in 2023. So that has grown by around 25%. But what we can see, COVID was very impactful to their bottom line. But again, it did pick up all the way to 2022 before dropping. So yes, both top line and bottom line are increasing year on year, but we do see inconsistencies. Now, in terms of their balance sheet, a health check, total cash versus total debt, 4.7 billion in 2019, 9.9 billion in their latest report. So they are holding quite a lot of cash, in fact double than what they did around 5 years ago. And when we compare that to their total debt numerically and directionally, well, it has gone up nearly 4 times from 3.9 billion to 12.2 billion. And we'll look at the net debt to EBITDA to see how that dividend as well as the company's strength is. Now, their competitors in the footwear industry, we have Deckers, Skechers, and a few others, including Puma, which are Crocs and which are very well known. Nike, year to date, including those dividends reinvested, are one of the worst performing, down 7%. When we expand that to the last 5 years, we do see they are up around 59%, but again, they aren't one of the best performing in the industry. And one thing that I would bear in mind is, are their market share becoming more and more contracted? So what we can see here, and bear in mind this is the 2022 data, we do still see for the footwear sales, they have a significant market share. 29.1 billion worth of footwear sold was from Nike. Their next closest competitor was Adidas. What is quite interesting though, these have been increasing over the last few years, and it would be interesting to hear your thoughts as whether or not you believe companies like Skechers, like Adidas or Lululemon, not just specifically relating to footwear, but are taking over the market share and maybe the appeal that Nike once had. Is Nike somewhere that you still look to as quality footwear, quality apparel, or is it one that actually you are starting to consider different options? Because this is how it starts, essentially, when consumers are thinking about other options and not typically those ones where maybe the last 5 to 10 years you'd automatically look towards Nike or even Adidas. When you do start considering different options, this is where we could see over the next few years their market share start to contract, whether it's in the footwear or apparel region. Now let's take a quick look at the institutional percentage. 64%, 63% institutional ownership. 9 billion of outflow sales by these institutions over the last 12 months. And what we can see over the same period, significant inflows by these institutions. We can see a huge amount of inflows in Q2 of 2023, with Q3 pretty much flat in terms of inflows and outflows. But as always, it is interesting to note, but with institutions, we always need to do our own due diligence before just relying on what they do. Now, when we take a look at their dividend safety score, it is 99. It is very safe. Market cap, 186 billion. It is a mega cap company. Now, recessionary metrics, for those that see a recession inbound, they increased the dividend during the 07-09 recession. Negative 7% sales, still above the average growth of the S&P, and they outperformed the S&P 500 by quite a strong amount, negative 36% versus that S&P's negative 55%. Dividend growth, I do quite like it from Nike, 9% in November this year, double digits over the last 5 years, 16% over the last 20 years. It is a very good dividend growth company, but you also want to ensure that that company is growing continually over the foreseeable future. They have been growing their dividends for the last 21 years or more, only 4 years away from becoming a dividend aristocrat. Dividend yield theory, for those of the new, states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Bear in mind though, we don't look at any of these models in isolation, and we will draw our conclusions towards the end of the episode. Forward PE, likewise, another sign of undervaluation, 28, below the 5-year average of 32. But we do see here the sector PE is significantly higher at 14.8, in fact significantly lower. As always, free cash flow over earnings, as it is susceptible to manipulation by management through accounting. One of the reasons that I will point out, 2020, you would have been quite happy, 52% earnings payout. But then what we see when we do look at the real number, the real effect, the free cash flow, this signals that the company paid out more in dividends than they generated in free cash flow. So always be wary of that. Now, over the last 3 years, we do see, in fact, below 50%. I like to see below 60%. Are able to offer those double-digit increases we love to see. 2023, 42%. 2024 expected to be slightly higher, so that we can see why that dividend does seem to be safe. Free cash flow per share is growing nearly 3 times over the last 10 years, but do note the inconsistencies. It isn't always consistent increases year on year. Sales growth, now this is one you do need to consider based on management's forward guidance, whether or not you believe this is just a one-off in terms of their revenue only increasing by around 1%, or if in actual fact you do believe over the longer term it will start to pick back up to at least an inflationary increase year on year, especially as they may be, depending on your vision, on your investment thesis, losing market share year on year. But overall, looking on the prior year data, it does look very solid. 27 billion, nearly 2 times their top line over the last 10 years, 51 billion in 2023. Now, they do return excess cash to investor pockets by doing share buybacks, 1.81 billion in 2014, 1.57 in 2023. ROIC, remember, 10% or more is what we look for to ensure management are able to effectively allocate their capital. Double digits and in fact low 20s, very positive to see, especially in 2023. Now, when we look at the margins, both free cash flow and operating, we like to see a minimum of 12%. They have pretty much been there consistently year on year, with 2023 coming bang on that 12%. Free cash flow margin, a pretty similar story. Now, net debt to EBITDA, for those that are new, earnings before interest, tax, depreciation, amortization, shows us 2 things. 1, the dividend safety, and 2, the balance sheet strength. 2023, this shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 0.19 years, very strong. 2024 expected to be pretty similar. So this company does have a very safe dividend as well as a strong balance sheet. Now, jumping into the valuation, and as always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, if you do want to grab a copy of the model, click on that pinned comment below where you can get to the intrinsic value and acceptable buy price of companies in your own portfolio. Firstly, we have Graham's valuation, stock ticker symbol NKE, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving us an intrinsic value of $77. Now, we can take a look at the current trading price. It is well below that, and in fact it is lower than the 52-week low, showing signs of overvaluation. But as always, we don't look at any of these models in isolation, and we will draw conclusions towards the end. We then have the multiples valuation model, where we have the average PEs of these companies we analysed earlier, multiplied by the earnings per share of NKE, to get a stock price here of around $80. Again, showing signs of overvaluation still to the current trading price, and even lower than the 52-week low. We then move on to the essential DDM model, dividend discount, with the yearly dividends, average growth rate very strong. Forward looking, I've personally gone 7%, but as always, depending on your investment thesis, you can play around with these numbers if you grab a copy of the model below. This gives a DDM price of 158. Now, it's below the all-time high, but it is above that 52-week high, so we do see signs here of undervaluation, so around 50% upside. DCF model, then we have the free cash flows year on year. Average growth rate 40%, forward-looking analysts estimating around 14%. In conjunction with our discount rate and present value of future free cash flows, we add them together with the cash and cash equivalents, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $135, signaling around 30% upside and pretty much just above that 52-week high. Now, as always, the intrinsic value here is just the average of these 4 models, and in today's episode for Nike, the intrinsic value comes to $112. Now, the current trading price isn't too far off that, around $109, and whilst we typically use 10% as a margin of safety, if we believe it has a wide moat, strong financial metrics, good forward-looking data, we don't believe you would be getting a 10% margin of safety until you hit around $101. If we look at 5%, it isn't too far off, so you could argue right now you are getting a 5% margin of safety. For those looking at 15% margin of safety, you'd be looking around $96, and those at 20% around $89.96. Personally, if this is one I would add, it would be around 20% margin of safety at around that 52-week low point that we can see. I do believe over the longer term they will be losing their market share. I don't believe that Nike as a brand is as attractive as it used to be maybe 5 to 15 years ago, whereas a lot of people would buy Nike just for the brand. We have a lot of options now in the market, and I do see the younger generation not as reliant on Nike as we were maybe in the past. Now, in terms of Wall Street, what do they say? They believe the share price to go up by around 20% to around $127. So in conclusion, for Nike, we see around a 5% margin of safety with around 20% upside per Wall Street analyst. As always, I'm really keen to hear your thoughts on Nike as a whole. Is this one you've added on the drop? Are you looking for it to go further, or maybe one you're not touching for any reason? As always, if you enjoyed the content, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, click that pinned comment below if you do want to get to your companies of your own or on your watch list, their intrinsic value and acceptable buy price.